But how should one look at when we talk about the investment strategy when we see it on the longer term perspective? Because the recent near-term volatility is still persistent in the market, but from an investor point of view, let's understand how should one read into the Fed's impending next rate hike and what will be the impact on the Indian markets and the world across. For this, we are being joined by a very special guest, Mr. Sunil Subramaniam, who is the MD and CEO at Sundaram Mutual Fund. And post that, we will be going to another discussion lined up with Mr. Arnav Pandya of Moneydew School. Welcome, gentlemen. And thank you for joining us today at ET Now. Firstly, Sunil, a whole host of questions lined up for you. Rate hike in the US is imminent, right? We will wait by to see whether the number is 75 basis point or even higher. But that's not the concern is. What we are more concerned of is about the growth, the future rate hike expectation and its impact in India. What's your view on the same, keeping today's Fed policy in view?
The Fed rate hike is a function of the fact that today inflation is far more important than growth to the US. Not only from the Fed's perspective, but the US political powers, because there is an election due in December of the Senate. As we know, growth may not get you votes, but inflation will definitely lose you votes. So the political side of the US, that is Joe Biden's government, is also putting pressure on the Fed to bring down inflation at any cost. So that can happen in a demand-led economy like US only by hiking interest rates. So when you hike interest rates, you are killing demand. So naturally, US economic growth will slow down and will ultimately slip into a recession. But from an Indian economy perspective, we are fairly decoupled from America because we don't have too much of exports to America in size of our GDP. So I think that Indian economic growth will not get much affected by the US slowdown or possible recession.
Well, yes, Sunil, so surely there are concerns around, but not just it has an impact on all those growth-oriented sectors, but look at the yield curve. The inverted yield curve shows the signs of recession. How can one read this? The US key voices have been strongly denying this, that we will not go into recession, but how do you take it?
Given the fact that the inflation has gone from 1.5% to 8.5%, and is caused by a mix of supply side factors starting with COVID and then with the Russia-Ukraine war, and a demand side factor because of the stimulus given by Fed through QE and the stimulus given by the US government through $3,600 giveaway to each American taxpayer. I think that the growth scenario in the US is going to get impacted if the Fed does not act on it. So the route through this action is only by hiking rates and killing demand. So in that context, I believe that since the Russia-Ukraine conflict is not showing any signs of ending, there is no choice but for the US to slip into a recession before the inflation can be brought under control. So in my view, there is a 75% plus probability of a recession happening in the American and the advanced economies like Europe also.
Okay, but Sunil, you did touch upon India decoupling factor. Now, surely Indian markets too are showing that resilience, but now looking at the rate hike scenario along with the robust demand across sectors in the domestic market, how long can we sustain this, the outperformance or the decoupling we are seeing in the Indian markets? How much confidence we should still have? And what about our export-oriented companies? They still have their export related to the overseas market. What's your take on that?
I believe that we have entered a space where we are getting decoupled from the advanced world. The reason for this is that what is the US suffering from in an inflationary scenario, the attempt to kill demand and bring down inflation and a recession will lead to a drop in commodity prices and drop in oil prices. Among the emerging economies, India is the one economy which imports 83% of its oil and also significant amount of commodities. So in a scenario where the commodity prices are coming down, an economy like India benefits from the reduced commodity prices in multiple ways. First, domestic inflation will come down from imported inflation risk. Second, our trade deficit and fiscal deficit will improve. Third, the amount of dollars needed to pay for imports will come down, hence the currency situation will improve. Fourth, the Indian corporate sector which uses the oil related products as inputs, they will also face a reduction in their input costs and a widening of the margin. So all of these factors put together means that in a recessionary scenario in advanced countries, Indian economy is poised to benefit. Now coming to the markets are also proving to be decoupled from the American markets. Why? Because in the period between October to June, about 2.5 lakh crores of money went out of India by withdrawal by FIIs, but all of it did not go back to America. Some amount went from the equity market to debt market of America because higher interest gave a good return there. But much of the money went to commodity exporting markets like Brazil away from India. Now with the deflationary scenario and a recessionary scenario coming, that money is like to reshift from the commodity exporting market to a commodity importing market like India. So FII flows will come and support the market. Third point of view is that Indian market, we have seen the strong support of domestic investors, because in the COVID time frame also we have seen Indian per capita income grow up, but because of the lockdown people did not have avenue to spend the money, so their savings increased, and including in the equity market, and the SIP book of 12,000 crores is providing a strong support to the domestic market. In view of this, the market is also turning to be decoupled, and while there may be a short-term panic reaction if the Fed rate hike is announced, because some hot money FIIs may pull out money, within a few days you will find the reallocation of capital from commodity exporter to India as well as the domestic flows will give us support and the market will bounce back. So I believe that India is in a sweet spot, both from an economy which will benefit from advanced country recession and a market which will benefit from flows in a decreasing oil price scenario. So India is in a very sweet spot at this point in time. I would feel that, in fact, if I may use the phrase, that in the land of the blind, a one-eyed man is king, and that is the status of India today.
So India is in the sweet spot, that's the word coming in, and you're showing a lot more confidence in the Indian markets, and definitely we are seeing in the up move right there. But at the moment, in the near term, what we are seeing that the markets are turned very much volatile, and especially when we see such events lined up like the FOMC meet at the moment, how do we balance our equity allocation? What's your view on that?
In the scenario that is in front of us today, with India being in a sweet spot with the world going into recession and the corporate sector bound to have an increase in the EPS, I believe that the macroeconomic factors for India are also turning positive. You have seen GST collections go up month on month. You have seen personal income tax grow 40% YOY. You have seen corporate income tax grow 30% YOY. All state government income streams are also on a rising trend. Plus the government, through the fiscal deficit expansion which went through in COVID, have invested the money wisely in the infrastructure program. Second is that through the PLI scheme, India is trying to take advantage of FDI money coming in and a China plus one strategy being implemented in certain very labor oriented sectors. So capital goods cycle will get a boost. Private sector also, with the capacity utilization crossing past the long-term average of 72 to reach 75%, means there are many sectors and many industries which are at the 80% level, and hence the need for them to expand capacity to meet demand in 2-3 years is now happening. So this capex cycle will give a strong boost to Indian GDP growth in the coming days, and hence you will find that domestic oriented companies will have a good order book and a good margin expansion. Hence, I believe that it is a sweet spot to increase your allocation to equity at this particular point in time.
Okay, the advice coming in to increase your allocation in equities in India is in the sweet spot and holding up strong. But with this, thank you so much, Sunil, for joining us today at ET Now and sharing your perspective and showing the confidence to our viewers how India is poised to grow further.